Equity valuation. In this chapter, we're going to introduce a couple of models to evaluate or price the equities. When you think of equities, you can simply think of stocks. So equities and stocks are the same. The first model is comparables. We're going to use different comparables or ratios to evaluate the stocks. The comparables or the multiples are used to value the companies based on basic fundamental key variables. The most common multiples include P/E ratio, the price divided by earnings per share, enterprise value ratios. P/E ratio. The price-earnings ratio is calculated as the current stock price divided by the annual earnings per share. Because the earnings per share are announced on the quarterly basis, so basically for 1 year, you will have 4 quarters earnings per share numbers. Wall Street journals and a lot of other major financial websites or newspapers use the last 4 quarters earning. It's called trailing P/E ratio because you use the last year's earnings numbers instead of the future 4 quarter estimated numbers. Okay, so basically you calculate the average of the last 4 quarters earnings per share and use that number in the trailing P/E ratio calculation. Sometimes people also calculate forward P/E ratio, which is the current price divided by the forecast future 4 quarters earnings per share. To use the comparables to evaluate the stock, we are going to compare that ratio with something else. For example, the major competitors or the industry average number to know whether the stock is over or undervalued. In this table, I gave you some examples. The two comparables we are looking at are the first one, market to book value ratio. The second one is P/E ratio. So the market to book value ratio is the market price or the current stock price divided by the book value of the stock. The book value of the stock is the value recorded in the accounting book. It's the historical number, not reflecting the current market price. Okay, so let's take a look at the FedEx first. FedEx market to book ratio is 1.9. The major competitors on average has a market to book ratio 5.2. Then you look at the P/E ratio, FedEx 22, the major competitors around 30. Okay, what does that mean? So we look at the P/E first. P/E ratio is a multiple, means per $1 of earning, what is the price level? So for FedEx, for every $1 earning, the price is 22 times. While the major competitors, for $1 of earnings, the price is 29.8 multiples, which means for each $1 of earnings, the competitors are more expensive, or the price of the competitors are higher and more expensive than FedEx. Similarly, if you look at the market to book value, the book value is the historical accounting value. So for each book value, FedEx has a multiple of 1.9, means for each book value, the market value of FedEx is 1.9 times or 1.9 multiples, while the competitors, for each dollar of book value or the historical accounting value, the competitor's price is 5.2 times or multiples. So both ratios pointing out that FedEx is relatively cheaper than its competitors. A common valuation approach is to multiply a benchmark P/E ratio by earnings per share to come up with a stock price. because the earning per share is a reported number on any major financial website, say Yahoo Finance or Google Finance. If we can know the benchmark P/E ratio, then we can estimate the stock price. So basically, the stock price will be the benchmark P/E ratio times the earnings per share. So here, the benchmark P/E ratio most often is the industry average or based on the company's own historical values. For example, for the past couple of years, you calculate the average of the company's P/E ratio. When you use the industry average, most of the time that is also a reported number. They average across all the industries in the same industry. Sometimes people can also calculate stock price using the price to sales ratio, which is the price per share divided by the sales per share. The logic is the same. Here is an example. Now suppose the company has earnings per share of $3 over the past year. The industry average P/E ratio is 12. Using the two information, we can calculate the estimated stock price will be the multiple of 3 and 12, $36 per share. The second model to evaluate the stock is intrinsic value versus market price. Before I introduce the model, I want to introduce the holding period return, or the expected holding period return. The return on the stock investment has two parts. The first one is dividend yield. The second part is capital gains or loss. Sometimes, stock price go up, you have a capital gains. Sometimes the stock price goes down, you will have a capital loss. Okay, assuming we have the 1 year holding period, then the expected holding period return will be expected dividends you are going to receive over the 1 year period, plus the capital gain or capital loss, which is calculated as the expected ending period price P1 minus your purchase price P0. The whole thing divided by P0, which is the purchase price or your initial investment in the company, in the stock. If you look at the formula, we can simply divide the formula into two parts. The first part is expected next period dividend, D1, divided by P0. This ratio is our dividend yield. The second part is the capital gains or the percentage of capital gains, which is the change in the price. Expected P1 minus P0 divided by P0. So this ratio is the percentage of the capital gain or capital loss. We have a second way to calculate the stock return, which is from the campaign model. The campaign model shows the required return is RF, T-bill rates, plus stocks beta multiplied by the market risk premium. If the stock price is correct, then the required return should equal the expected return. So basically, if the stock is fairly priced, then the return from the campaign model should equal the returns from the holding period or the expected holding period return. The intrinsic value of the stock is the present value of all cash payment to the stock investors. If you want to have a formula, the intrinsic value of the stock is going to be the expected next period dividend plus the expected new price at the end of the next period, P1, discount back at 1 plus K. So here the discount rate K is calculated from the campaign model. So the market price is different from the intrinsic price most of the time. The intrinsic price is the price you think should be based on the model I presented there. You calculate all the present value of future cash flows, while the market price is the current market price. That is a given number to most of the individual stock traders, right? So whenever you check the price of the stock, That is the market price, the price you can buy and sell. So basically, the market price is the consensus of all the potential traders, but each potential trader has its own intrinsic value of the stock. The market price is like an average or consensus of all the potential traders. The current price, of course, reflects the intrinsic value estimates, but sometimes it will be different from the intrinsic value. Equity. So how do we use the intrinsic value and the market price to buy and sell stocks? Well, simply we can compare the intrinsic value and the market price. If the intrinsic value or the estimated stock price based on your own calculation is higher than the market price, means the stock is currently undervalued. It is a buy signal. If the intrinsic value you calculated is lower than the current market price, then this is a sell signal or short sell signal. If the two numbers equal, then it's fairly priced. You can either hold or do nothing. For example, there is a stock. You estimate the stock will deliver $4 dividends over the next year, and you believe you can sell the stock at $52 at the end of the next period. K, or the required rate of return from the campaign, is 12%. Based on those information, you can calculate the intrinsic value, which is 4 plus 52. Those are the two cash flows you can get over the next period, discounted back to time zero at 1 plus 12%. The price is $50. So basically, the intrinsic value is $50, means you believe the stock worth about $50. While the market price, when you check Yahoo Finance, the current market price is only $48, means you can buy and sell the stock at $48. Well, this is a buy signal because you think the stock worth $50, while in the market you can buy it at $48. Your estimated return will be $2. The third model to evaluate the stock price is called the dividend discount model. This is the most important model I want to introduce, and it is very popular and very widely used in the industry. The general form of the dividend discount model is, suppose you hold the stock forever. You never sell the stock, which means all the cash flow from the stock will come from the dividends. Okay? Which means as long as you can discount back all the future dividends, then you can calculate the intrinsic value. So the intrinsic value of the stock is going to be the sum of all discounted dividends in the future. So here, V0 is the stock value, DT is the dividend in each period, K, again, is the return from the campaign model. But the problem with the general model is it is extremely difficult to estimate the dividends forever. This is such a long time period. And how can we simplify this model? So let's do something new with it. Now suppose we add a new assumption to the model. Say, suppose the dividends will grow at a constant rate, say 5%. Well, then we can simplify the model a little bit. D1 will be D0 times 1 plus the growth rate, because it's a fixed number, right? So D2 equals D0 times 1 plus G squared. D3 will equals D0 times 1 plus G to the power of 3 periods, so on and so forth. Here is an example. Now suppose D0 is $3.81. Then we can calculate D1, D2, D3 by multiply by 1 plus 5% to the appropriate time period. Then we can simplify the general model. We can take out the D0, okay? Because now DT becomes a model or becomes a formula of D0. So DT equals D0 times 1 plus G to the power of T periods, right? So D0 is a constant number. In our example, $3.81. Then the whole thing is a ratio. As long as the growth rate is lower than your return, as long as the G is lower than K, this ratio is a number smaller than 1. Okay? So a smaller than 1 ratio to the power of t. As t approach to 0, this ratio will approach to 0. Then we can simplify our general model to V0, the intrinsic value, equals D1, the next period dividend, divided by K minus G. Okay, so in our numeric example, the D1 is $4, K 12%, G growth rate 5%. Then the intrinsic value will be $57. Based on the dividend discount model, you estimate the stock price will worth about $57. But here I want you to pay attention. The growth rate has to be lower than the K, the required rate of return. If the growth rate is higher than K, then the whole thing is going to be a number greater than 1. If a number greater than 1 to the power of t goes to infinity, this number explodes. Okay, so the intrinsic value will be infinity. We cannot use this model anymore if the growth rate is higher than the required rate of return. If the G is higher than K, we cannot use this model. Dividend discount model is the basic model of equity valuation. The price you calculated from the dividend discount model is also called intrinsic value. So if the calculated number, the intrinsic value, is higher than the market price, then the trader will think the stock price is undervalued. It is a buy signal. If the intrinsic value or the price you calculated from the dividend discount model is lower than the market price, the stock is overvalued. It is a sell signal. So P0 equals D1 divided by K minus G. This is the basic form of the dividend discount model, and we call it constant growth dividend discount model because here we assume a constant growth rate of the dividends, which is G. If the company is fairly priced, P0 and so P0 market value is going to be the intrinsic value you calculated from this formula, V0. Okay, so the intuition here is very sensible. The stock price will go up with the expected dividends. So if expected dividends goes up, your price goes up. Reflected in the formula, D1 and P0 are both in the numerator, so they have a positive relationship. The second one is price falls with the required discount rate. Means P and K has an inverse relationship, which is also reflected in the formula. K is in the denominator. It is inversely related with the P0. Price will go up when the growth rate of dividends goes up. So P0 and G are positively related. G is in the denominator, but there is a negative sign in front of it. So in the formula, P0 and G are still positively related. Okay, so let's check what is the relationship of the price with the growth rate. According to our formula, P0 equals D1 divided by K minus G. Then what is P1, the next period price? P1 will be the next period dividend, which is D2 divided by K minus G. As you can see in this formula, the denominator K minus G never changed. It's a fixed number. So D2 equals D1 times 1 plus G. If you look at this formula, D1 divided by K minus G, that is exactly our P0 in the formula, right? So P1 equals P0 times 1 plus G. Okay, so basically it means the price will also grow by the same rate as dividend, which is G. In our example, D2 equals D1 times 1 plus 5% growth rate, $4.20. So what is P1? P1 will be D2, $4.20, divided by 12 minus 5%, $60, which is exactly P0 times 1 plus 5% growth rate. So here you can see P1 versus P0. The difference is just 5% growth rate. If we rearrange the constant growth dividend discount model and we move K to the left-hand side and P0 to the right-hand side, okay, then what we can get is K, our expected return, equals D1 divided by P0 plus G. So basically, the return of the stock, K, can be divided into two parts. The first one is D1 divided by P0, which is the definition of the dividend yield. The second part is the growth rate. What is G? In our previous slides, we showed you the growth rate G is the constant growth rate of dividends and the constant growth rate of the price. So P1 minus P0 divided by P0, that is the percentage increase or decrease in the stock price. So that is exactly G, the percentage change in the capital gains or capital loss. So basically it says, according to the dividend discount model, the expected return of the stock is going to be dividend yield plus capital gains. Now you may wonder, how do you calculate the G? How do you estimate the growth rate? The G is calculated as the return on equity times the plowback ratio. So the return on equity is reported in the financial statements. It shows you if the firm takes on the new projects, what is the return on those new investments. Plowback ratio is the retention ratio or 1 minus the dividend payout ratio. For example, if the company made $5 earnings per share, the company can decide whether they want to pay out all $5 as dividends to the shareholders, or they can keep some money to invest in new projects. For example, if the financial manager decides to keep $3 to invest in the new projects in the company and pay out only $2 as dividends, then the dividend payout percentage will be 2 divided by $5 earnings, 40%. So the remaining $3 will be plowed back in the company to invest in the new project. So the plowback ratio will be 3 divided by 5, 60%. So 40% dividend payout ratio plus 60% plowback ratio is 100%. So sometimes when you calculate the plowback ratio, you can also use the formula 1 minus the dividend payout ratio. Now we have two companies, cash cow company and growth prospect company. Both companies have expected earnings of $5 per share. They can decide, okay, let's pay out the $5 earnings per year as dividends indefinitely, forever. So each year we generate $5 earnings and we pay it all out as dividends, give it back to the shareholders, which means the company will retain or keep no money at all. So there is no investment. So the growth rate is 0. Assume the discount rate is 12.5% for both companies. So the price for both companies will be D1 divided by K minus G. Here, D1 is earnings because you pay out everything as dividends. So $5 earnings or $5 dividend divided by K, which is 12.5%, G is 0. So the stock price is $40. Or you can use the formula P0 equals E1 divided by K. It's the same number, $40, because here D1 is E1. you pay out all earnings as dividends. So the growth rate is 0. We can get it, take it out from the formula. Okay, so that is the initial setup. If both companies decide to pay out all earnings as dividends, both companies will be priced at $40 per share. Now suppose the growth prospect want to change the payout policy. Now they identify a very good project. The new project will return 50% return on equity. Means if you invest in this new project, you can generate 15% return. Okay? Well, if you have this new project, do you think the company will still pay out all earnings as dividends? No, because if the company can keep some of the earnings and invest in this 50% return project, that return is higher than the required return from the shareholders, 12.5%. Means the shareholders will be happy to take on this new return because 15% is higher than the return they required, 12.5%. So the growth prospect company will choose a new dividend payout policy. Instead of paying out everything, now they only pay out 40%. With 40% payout ratio, the dividend will be $5 earning times 40%. That is $2. So the plowback ratio will be the remaining $3 or 60%. So the investment in the next period will be $3. Let's see what happened to the stock price of the growth prospect. Well, first of all, we know we cannot directly plug in the numbers in our old formulas. So $2 new dividends divided by K, 12.5% minus G, which is 0, equals $16? No, because G is not a fixed number. G depends on our investment and plowback ratio. G equals 0 in the first case because you didn't make any investment. But here, the new investment has a return on equity of 15%. The plowback ratio is 60% or 9%. 15 times 60% equals 9%. Okay? So the price of the growth prospect will actually go up. How do we do that? P0 equals D1, which is $2, divided by K minus G. K is again 12.5%, but now the growth rate is 9% instead of 0%. When you plug in the new numbers, you calculate the stock price is $57.14 for the growth prospect. Based on this numeric example, we get another version of the dividend discount model. So starting from P0 equals D1 minus K minus G, now we can modify the formula to E1 times 1 minus plowback ratio. So here, dividend 1 is calculated from the earnings 1. So E1 times 1 minus the plowback ratio, which is the dividend payout ratio, right? So the dividend payout ratio is 1 minus the plowback ratio divided by K minus G. Now G is calculated as return on equity times the plowback ratio. To summarize, now we have three interpretations of the dividend discount model. The first one is the simplest dividend discount model, which is P0 equals D1 divided by K minus G, constant growth model. The second interpretation is in terms of the returns. The expected return is the dividend yield plus capital gains. The third interpretation is in terms of earnings, return on equity, and plowback ratio. So D1 is calculated from next period earnings times 1 minus the plowback ratio or the retention ratio. K minus G is return on equity times the plowback ratio. Now I will introduce a fourth interpretation of the dividend discount model. I'm going to decompose the price into two parts. The first one is the value of asset in place. The second part is the value of the growth opportunity. So the value of asset in place is the no growth value per share, plus the present value of the growth opportunity. If you like formula, P0 equals the no growth value is E1 divided by K, plus the present value of the growth opportunity. If you still recall the cash call and growth prospect example, when we calculate the price of the cash call, which is $40, using the formula E1 divided by K, because the cash call or the no growth company pay out all earnings as dividends. So D1 equals E1. There is no growth. G equals 0. So the no growth company or the cash cow company stock value is E1 minus K, $40. Remember when we calculate the growth prospect company's price, because now the company has better project. The project yields 15% return, and the growth prospect company chose 60% plowback ratio, and we calculate the stock price was $57.14. Basically, the difference of the two stock price, 57.14 minus $40. The difference, $17.14, is the present value of the growth opportunity. Now, what if the cash cows also have some project which has 12.5% return on equity, and it also want to reinvest some of the earnings into the company and take on this new project? The reinvestment rate is 60%, or the plowback rate is 60%. Well, before we do the calculation, I'm going to show you the stock price will not change at all. It will still be $40, because the new project's return on equity is 12.5%, which is the same as the required rate of return K, 12.5%. So the shareholders will be indifferent between investing or not investing. Now we plug in the numbers and see whether it is true. So the earnings is $5. Dividend payout ratio 40%, which is 1 minus 60% plowback ratio. So the dividend will be $2 for the next period. K, 12.5%. Growth rate will be the return on equity times the plowback ratio, which is 12.5% return on equity times 60% reinvestment rate, which is 7.5%. So you calculate the stock price, $2 dividend divided by 12.5 minus 7.5%, $40. Why? Because when the return on equity equals the K, there's no reason to reinvest. The present value of the growth opportunity is 0. The stockholders will be indifferent between investing or not investing. But if the return on equity is lower than the required rate of return, 12.5%, then you shouldn't do reinvestment, because that will hurt the shareholders. Now let's do another exercise. The return on equity of the new investment project is 20%. Dividend payout ratio 60%. Earnings $5. K 15%. So let's first calculate what is next period dividend and the growth rate. D1 will be $5 earnings times the dividend payout ratio, 60%. So $5 times 60%, $3. Growth rate will be 20% return on equity times 1 minus the dividend payout ratio, that is the plowback ratio, 40%, or 8%. Now let's calculate what is the stock price and what is the present value of the growth opportunity. We first calculate the stock price with the investment, which is $3 D1 divided by 15% minus the growth rate, $42.86. Then we calculate the no growth value per share. Assuming you do not invest in the new projects, you pay out all $5 as dividends. So there will be no growth. G equals 0. So 5 divided by K, 15%, $33. So the difference between the two prices will be the present value of the growth opportunity, which is $9.52. People often use the stock market to predict the total economy because the stock market is a leading indicator for the economic's growth. Leading indicator means the upturns in the stock market means a prediction for the coming economic expansion. The downturns in the stock markets is taken as a signal of a coming economic contraction. So in this formula, because the stock price is a leading indicator of the economic's growth, most of the time the present value of the growth opportunity will go up before a economic expansion, and the present value of the growth opportunity will decline before a contraction in the economy. Now to summarize again, we have 4 interpretations of the dividend discount model. The first one is the simplest basic model. The second one is in terms of the returns, and we decompose it into dividend yield plus capital gains. The third one, we rewrite everything in terms of earnings, plowback ratio, and return on equities. Fourthly, we have the no growth value, E1 divided by K, plus the present value of the growth opportunity. Now let's do some exercise. Low-tech company has expected return on equity 10%. The dividend growth rate G will be what if the payout policy is 40% of the earnings will be paid out as dividend. So the growth rate G will be return on equity 10% times the plowback ratio, which is 1 minus 40% dividend payout ratio. A preferred stock will pay a dividend of $2.75 in the upcoming year. So this is D1. And every year thereafter means the stocks will pay the same dividends forever. There's no growth. So the growth rate is 0. Required rate of return, K, 10%. So what is the price of the preferred stock? We are going to use the no growth stock valuation, which is D1, $2.75 divided by the K, which is 10%, $27.50. Equity Chap013 is expected to pay a dividend of $1. So expected payment, which is D1. Dividends are expected to grow at 6% a year. So G equals 6%. Risk-free rate 5%. RF equals 5%. Market return 13%. The stock has a beta of 1.2. The first question asks you what is the required rate of return K. We're using the campaign model, 5% risk-free rate plus 1.2 times the market risk premium. So K equals 14.6%. In the second question, now we can calculate the stock price, which is D1, $1 divided by K, calculated in the first question, 14.6% minus the growth rate, 6%. So the stock price is $11.62. Equity valuation. This question is a little bit tricky. Chap013 is expected to pay a dividend of $2 in the upcoming year. So the word expected and upcoming means this is dividend 1, D1 equals 2. Risk-free rate 4%. Market return 14%. Analysts expect the price of the Chap013 will go up to $22 a year from now. So here the expected P1 is $22, beta 1.25. The first question asks you what is the K, or the market required rates of return on the short-term stock. K will be calculated from the campaign model, 4% plus beta times the market risk premium, which is 16.5%. And based on the information, what will be the stock's price today if it equals to its intrinsic value? The intrinsic value will be the discounted value of all future cash flow. In this example, dividend in the next period will be $2. Price in the next period, $22. You discount it back at 16.5%. Then the P0 is $20.60. The next question asks you what is the growth rate. We are going to use the dividend discount model. P, which is $20.60, which is given. D1, $2. K, 16.5%. We know all the numbers, and then we can back out the G, which is 6.79%. High-tech company paid a dividend last year, $2.50. So the word here, paid, and last year means this is D0. So D0, the dividend you received, $2.50. The expected return on equity, 12.5%. Appropriate required rate of the return on the stock is 11%. Plowback ratio, 60%. What is the next period dividend? Well, to calculate the D1, we first need to know what is the growth rate. The growth rate is return on equity, 12.5%, times the plowback ratio, 60%. So the growth rate is 7.5%. D0 equals $2.5. So $2.5 times 1 plus G, 1 plus 7.5%, we can calculate the D1, which is $2.69. Low-fly airplane is expected to pay a dividend of $7 in the coming year, so D1 equals $7. Dividends are expected to grow at 15% a year, so G equals 15%. Risk-free rate 6%. Market return 14%. Beta 3. What is the intrinsic value? What is the price of the stock? So first of all, we calculate the K from the campaign model, which is 6% plus beta times the market risk premium, 30%. Then we plug in all the numbers in the dividend discount model, $7 D1 divided by K minus G. The stock price is $46.67. So far, we have assumed the growth rate G is a constant number, so that is why we call it constant growth dividend discount model. But let's be more realistic. Let's release the constant growth rate assumption. First, we look at the zero growth case. We will assume the dividends will remain the same, which is a preferred stock. So the preferred stocks will pay the same amount of dividends forever, no increase at all. So that is the first case. D1, D2, D3, and D forever will be the same number. Then we can change the stock formulation a little bit. So P0 is going to be all the discounted value of the future dividends. But D1, D2, D3 are all the same number, D. Then we can simplify this model to P0 equals D, the constant dividend, divided by the K. The second case is the constant growth model, which is the most popular model, and we have done a lot of exercise on it. P0 equals the next period dividend, D1, divided by K minus G. In the last case, we're going to calculate the differential growth model. Well, here we are going to assume the dividends will grow at different rates in the foreseeable future, and then will grow at a constant rate forever. For example, a startup company, in the foreseeable future, say the next 5 years, the growth rate is going to be really high, say 50% a year. And then after 3 years, it becomes a mature company. The growth rate will be stabilized at, say, 3% forever, right? How do we value a stock like that? To value a differential growth stock, we need to do 3 things. First, we estimate the future dividends in the foreseeable future using a different rates. And then we estimate the future stock price when the stocks become a constant growth stock, as in case 2. And then we combine the two together. Let's look at the following numeric example. A common stock just paid a dividend of $2, so D0 equals $2. The dividend is expected to grow at 8% for the first 3 years, and then starting from year 4, it will grow at 4% forever. How to value the stock price if the discount rate is 12%? All we need to do is to draw a timeline. So D0 equals $2, which D1 is $2 times 1 plus 8%, because in the first 3 years, the dividend will grow at 8%, so D1 equals $2.16. D2, $2 times 1 plus 8% squared, that is $2.33. D3, $2 times 1 plus 8% cubed, $2.52 in calculation. Starting from year 4, we can use the constant growth model because starting from year 4, the dividend will grow at 4% forever. So let's first calculate D4. D4 is D3 times 1 plus 4% is $2.62. When we are using D4 in the constant growth model, we are actually calculating the price as of year 3. So P3 equals D4 divided by K minus G. K minus G is 12% K minus 4% constant growth rate, 8%. So P3 equals D4, $2.62 divided by 8%, $32.75. So to calculate the total price of the stock, we need to discount back all the future cash flows. So at period 1, the only cash flow is D1, $2.60 divided by or discounted at 1 plus 12%. Second cash flow, D2, $2.33 divided by 1 plus 12% squared. Plus, in year 3, we have 2 cash flows. One is D3, $2.52. Another cash flow is the P3, the price as of year 3, which is $32.75. The 2 cash flows will be together discounted at 1 plus 12% cube. So the total price of the stock as of today is going to be the sum of the all 3 terms, $28.89. In this section, let's talk a little bit more about the P/E ratio since it's so important. P/E ratios are a function of 2 factors. The first one is the required rate of return, K. Most of the time, K is calculated from the campaign model. The second factor is the expected growth in dividends, which is G. P/E ratio is used extensively in the industry. It is used as a relative valuation method. To use the P/E ratio, most of the time you are going to compare the P/E ratio of a particular company with the industry benchmark P/E ratio or its major competitors' P/E ratio. Now we are going to write the P/E ratio in terms of our constant growth dividend discount model. We start from the basic model. P0 equals D1 divided by K minus G. Rewrite everything in terms of E, plowback ratio, and return on equity. D1 equals the next period earnings, E1, multiplied by the 1 minus the plowback ratio. So 1 minus PB is the dividend payout ratio, divided by K minus G. G is return on equity times plowback ratio. So now we can calculate the P/E ratio. So P0 divided by E1 So basically, both sides we are going to divide it by E1. Left hand side we have the P ratio, right hand side we can get rid of the E1. So basically, PE or P0 divided by E1 equals 1 minus the plowback ratio or your dividend payout ratio divided by K minus G. If we want to write the P/E ratio in terms of the present value of the growth opportunity, we can start from the second formula. P0 equals E1 divided by K, which is the no growth value, plus the present value of the growth opportunity. So divide E1 on both sides. We have P0 divided by E1. Our P/E ratio equals 1 over K times the whole thing 1 plus present value of growth opportunity divided by the no growth value. Again, no growth value is E1 over K. Either way, in both formula we showed you the P/E ratio is determined by two key factors: growth prospects, G, or present value of the growth opportunity. Higher growth rate, G, or higher present value of the growth opportunity will lead to higher P/E ratio. Discount rate, K, is the second factor. Higher K, because K is in the denominator, so higher K will lead to lower P/E ratio. Please note here the P/E ratio is the forward-looking P/E ratio because we are using the E1, the next period earnings. Now let's look at P/E ratio with no expected growth. When there is no growth, the no growth value P0 equals E1 divided by K. So P/E ratio is just 1 over K. The P/E ratio under the constant growth rate will be PE equals 1 minus the plowback ratio divided by K minus the plowback ratio times return on equity, which is G. Equity valuation. We first look at some numeric examples. The first case is no growth. When there is no growth, G equals 0, and all periods earnings will be the same number, $2.50. K, 12.5%. Those are the information we know. Now calculate P0 and PE ratio. P0 will be D1 divided by K. D1 equals E1 or E0, $2.50. Because there is no growth, all earnings will be distributed as dividend. So the price is $20 in this example. The PE ratio will be $20 price divided by $2.50 earnings. The PE ratio is 8. Means per $1 of earning, the price is 8 times. Or we can use our previous formula in the no growth case. P/E ratio is just 1 over K. So 1 over 12.5%. We have exact same number, 8. Now with growth, again E0 is $2.50, K 12.5%, plowback ratio 60%, return on equity 15%. Now let's calculate the next period earnings, dividends, growth rate, price as of today, and PE ratio. So the growth rate will be 15% return on equity times 60% plowback ratio, 9%. Once we calculate the growth rate, we can calculate the next period earnings, which is current earning $2.50 times 1 plus 9%, $2.73. D1 is going to be $2.73 E1 times 1 minus the 60% plowback ratio, so 40% will be the dividend payout ratio. D1 equals $1.09. According to the constant growth model, P0 will be D1 divided by K minus G. So you plug in all the numbers we calculated. You calculate the stock price, $31.14. Now we can calculate the PE ratio, which is price divided by earnings, 11.4 times. Or we can use our previous formula to calculate the PE ratio. The P/E ratio can also be calculated as 1 minus the plowback ratio divided by K minus G, which is also 11.4 times. P/E ratio is commonly used to evaluate company and the market. Remember in our previous examples, we have the cash cow and growth prospects. Using the numbers we calculated before, we can calculate the P/E ratio for the cash cow and growth prospect, 8 and 11.4. So although the two companies make the same amount of earnings, $5, but because of the growth prospects or the higher growth rate of the growth prospect company, the P/E ratio for that company is higher, and the growth prospect company has a higher price. Well, in the formula, the P/E ratio are calculated as the forward P/E ratio or forward-looking because we are using the forward estimated earnings, E1, the next period earning. But in the real world, the P/E ratios are backward looking. Well, the earnings are used in the past calendar year or fiscal year, which is called trailing 12 months P/E ratio. Or if you want formula, in the real world, when Yahoo Finance, Google Finance report the P/E ratios, they are actually reported P0 divided by E0. So how do we use the formula to calculate the trailing P/E ratio? Or how do we calculate P0 over E0? Well, E1 equals E0 times 1 plus G. So the difference between E1 and E0 is just 1 plus G. Then we can add this 1 plus G in our previous formula. No matter we are using the forward-looking P/E ratio or a trailing P/E ratio, we can see riskier stocks will have a lower P/E multiples. Why? Because riskier stocks will have a higher required rate of return to compensate for holding a higher risk. When the K is higher, K is in the denominator. Higher K will lead to a lower P/E ratio. In this picture, we show the different valuation ratios for S&P 500. The blue one on the top is the P/E ratio. Middle one, the black one, is the PS ratio, which is the price over sales times 10. The bottom one, the light blue, is the price over the cash flow. As you can see, the three valuation ratios mostly move together, with P/E ratio is a lot more volatile. And finally, I want to remind you, when you are using the P/E ratios, you want to make sure you're comparing the P/E ratios of companies within the same industry, because different industries have very different P/E ratio. For example, the biotech industry, the P/E ratio is extremely high, over 57, while in the defense industry, the P/E ratio is relatively low, 8.5. So if you are comparing the P/E ratio of a biotech company with another company in the defense industry, it doesn't really make any sense. P/E ratio, of course, is the most important valuation ratio, but people also use other valuation ratios. For example, price to book, accounting historical value is called book value, price to cash flow, price to sales, or you can be creative, use the price to whatever the fundamental value of the company.